All right, let's just dive right in. Today, we're doing a complete teardown of exactly how PGIM's AAD ETF is engineered to navigate the often chaotic world of fixed income. We are going to look under the hood of this specific investment vehicle to understand its mechanics, but more importantly, we're going to see how it's purposefully designed from the ground up to manage risk in your portfolio.
Because, this is the ultimate investor dilemma, right? Reaching for income usually means you're exposing your portfolio to volatile credit risks, or you're opening yourself up to wild interest rate swings. But what if a fund was built, like a literal machine, to specifically and systematically manage those exact risks? To figure this out, here's our roadmap for this explainer. First, the yield and risk dilemma. Then we'll peek inside the AAD ETF, examine its AAA CLO core, understand its duration overlays, and finally, look at the guardrails and the balancing act that keep the whole shebang on track. Let's get to it.
Starting off with Section 1, the yield and risk dilemma.
There is this fundamental teeter-totter effect in fixed income. It's a classic trade-off. If you want more return, you traditionally have to accept that borrowers might default, so that's your credit risk. Or you have to accept that rising interest rates will absolutely crush your bond's value, and that's your interest rate or duration risk. Finding that sweet spot between chasing yield and fearing these risks, well, that is absolutely crucial, and it's the primary challenge for any portfolio manager. Which brings us to Section 2, inside the AAD ETF. Meet the PGIM AAA CLO Aggregate Duration ETF. It's traded on the NYSE Arca under the ticker AAAD. Now, this is an actively managed exchange-traded fund charging a really competitive net expense ratio of 0.19%. Its stated goal is simple, but definitely ambitious. It seeks to maximize total return through a combination of current income and capital appreciation. But the way it systematically manages risk to actually achieve that is the real game changer we're focusing on today. The crucial point here is that they're aiming for enhanced yield by utilizing their massive, and I mean massive, $1.2 trillion credit platform to access very specialized securitized products. Edwin Wilches, the co-head of securitized products at PGIM, really hit the nail on the head. He pointed out that the goal is to beat the yield of traditional high-quality sectors, but without sacrificing that high-quality safety aspect. And honestly, that's the first major pillar of their entire risk management strategy. Moving right along to Section 3, the AAA CLO core. Okay, before we go any further, let's bust some jargon real quick. A CLO, or Collateralized Loan Obligation, it's really just a bundled pool of loans. That's it. Now, this ETF focuses predominantly on the senior tranches of these bundles. Picture a giant waterfall of cash payments. Because these senior tranches sit at the very top, they literally get paid first. If the underlying loans default, the bottom layers absorb those losses. So structurally, it's designed to insulate you, the senior investor, from risk. And here's a massive number for you: 80%. Under normal circumstances, at least 80% of this fund's investable assets are strictly dedicated to US dollar-denominated CLOs rated AAA. That is the absolute highest credit rating available, period. By anchoring 80% of the entire portfolio in AAA-rated instruments, the fund is effectively putting a huge dampener on its credit risk. And the fund actually sources this engine power by investing heavily in its sister fund, the Morningstar Gold-rated PGIM AAA CLO ETF, ticker PAAA. This gives AAAD immediate, highly diversified access to a massive, established pool of AAA CLOs. We're talking about a fund that has accumulated over $10 billion in assets. In fact, if you look at recent holdings data, you'll see millions of dollars from AAA deployed straight into PAAA, instantly acquiring that supreme credit quality. Let's shift gears to Section 4, steering with duration overlays. All right, jargon check number 2, duration. Duration is really just a way to measure interest rate risk. Generally speaking, the longer the duration, which is measured in years, the more a bond's price will drop when interest rates rise. So if you have a duration of 3 years, a 1% rise in interest rates drops your value by roughly 3%. Make sense? So here is the main mechanical challenge the fund faces. CLOs inherently have a very low duration, typically way under 1 year because they're floating rate. But investors often want a core-like bond experience. They want their portfolio to match the broader U.S. bond market's duration, which is usually about 5 to 6 years. So how on earth does AAD give you the safety of a CLO, but the duration of the broader bond market? Well, to steer the fund and actually extend that duration, the managers use an overlay of derivatives, things like U.S. Treasury futures, interest rate swaps, options, forward contracts. Think of these as financial levers. By holding these contracts, they don't have to go out and buy entirely different long-term bonds. They can just artificially dial the interest rate sensitivity up from less than a year, extending it to roughly 5.8 years to mimic the broad U.S. bond market perfectly. This is exactly how they actively manage interest rate risk without compromising that high-quality credit core we just talked about.
On to Section 5, Guardrails and Active Management.
Now, even with a great engine and precise steering, you still need brakes, right? To prevent a failure in one isolated corner from sinking the whole ship, strict diversification limits are hardwired right into the fund's prospectus. It guarantees the fund never takes on excessive concentration risk. For instance, there's a hard maximum of 10% in any single CLO concentration, a max of 10% in fixed-rate CLOs. No more than 20% can dip below AAA, and even then, it can never, ever go below an A rating. This is structural risk management in action.
And working inside those guardrails are the human drivers, the portfolio management team including Edwin Wilches, Gabriel Rivera, and Connor Burns. They're actively trading the portfolio. They use top-down macroeconomic trend analysis to gauge where the broader economy is heading, but they combine that with rigorous bottom-up health checks on individual issuers. So they aren't just letting some algorithm run on autopilot. They're actively managing credit and market risk every single day based on real-time data.
And finally, Section 6, a balancing act. Because, let's be real, no investment is completely bulletproof. The sub-advisors have to constantly monitor very real threats. Since they use derivatives to manage duration, they face counterparty risk, which is just the risk that the person on the other side of a swap might default. They have to monitor the liquidity of the underlying loans, especially when the economy takes a hit and things get hard to sell. They even have to monitor the specific CLO managers who bundle the loans in the first place, just to make sure their interests actually align with the fund's risk tolerance. It is a massive, active, daily balancing act to keep the fund on track.
So as we wrap up this explainer, I really want you to consider your own investments. We've just seen how AAD combines an engine of AAA-rated CLOs to manage credit risk with a steering mechanism of derivatives to manage interest rate risk, all securely locked inside strict diversification guardrails. So ask yourself, is your fixed income strategy systematically engineered to balance risk and reward? Or are you just sort of hoping the teeter-totter doesn't tip? It's a pretty fascinating look into modern portfolio construction, and honestly, a critical question for your own financial roadmap.